Good afternoon, ladies and gentlemen. I should, of course, say good afternoon to those of you who are joining me on the East Coast, and good morning to those of you who are joining us from the Central Time Zones, the Mountain Time Zones, or the Pacific Time Zones. I also want to say good evening to any of you who are joining us from across the pond in parts of the UK or parts of Europe, and good early morning if any of you are joining us from Australia or parts of Asia. Welcome to today's presentation, an introduction to the PowerOptions tools. Today we're going to discuss tips to help you save time with your options research and analysis. We're also going to take a look at the portfolio tool there to show you how you can use our portfolio tools to help you not only track and manage your positions, but also evaluate rollout opportunities and different adjustments. We're going to begin in just a few moments. We're going to allow some time for some more of our registrants to join us here in the room. I am, of course, flying solo on these presentations, but I want to encourage you, if you have questions or something that you need to be reviewed as we go through the presentation, just use the question pod on the GoToMeeting technology to send that information to me as a question, and I'll make sure that we cover that. Bob just asked, will this be recorded? Yes, this is being recorded, Bob. We will probably post this later on this afternoon to replace one of the existing webinars, and I'll show you where on the PowerOptions tools you can access our existing webinars as well at any time on the public page there, or if you're logged into your PowerOptions account as well. Just a reminder, I want to encourage those of you that are currently on your 14-day free trial or are subscribers to PowerOptions, you want to take advantage of those free coaching sessions. The free coaching sessions, they're not sales calls, they're really just educational. You can schedule one of those sessions at any time. The session is essentially a 35 to 40-minute phone conversation with myself, Ernie Zarenner, the president and founder of PowerOptions, or Greg Zarenner, the vice president of PowerOptions as well. So we'll walk you through the tools on the site, answer any questions that you have about options strategy, options adjustments. That's a benefit that you get as a PowerOptions trial member or a subscriber. All right, well, let's go ahead and begin. And what we always want to start off with this presentation is, what exactly is PowerOptions? Well, PowerOptions is a patented suite of search and analysis tools designed for self-directed options investors. Our tools allow you to search the universe of options in over 23 different strategies, so you can identify only those positions in a given strategy that match your personal risk-reward tolerance using your stock criteria and option criteria. Once you have identified the positions that match your risk-reward tolerance, you're going to be able to quickly compare the risk versus reward and do further research and analysis. And then, of course, as I mentioned, we have those powerful portfolio tools to help you paper trade, track, manage, and evaluate adjustments for your positions. Of course, in addition to that, we offer countless educational articles, hours of archived webinars, both related to option strategy and the tools on the site, and many help pages to get you not only more familiar with the tools on the site, but also the various option strategies that are commonly used by investors. As I mentioned, Ernie Zarenner created the PowerOptions tools 15 years ago after he retired from Hewlett-Packard. Of course, everyone here at PowerOptions, myself included, uses these tools to trade their own personal accounts. We have many more years of combined trading experience, and we're available by phone, by email, or through those coaching sessions to share our education and our knowledge with you. For those of you that don't know me, my name is Mike Chupka. I'm the Director of Education here at PowerOptions. I've had the great pleasure of working with Ernie Zarenner and the PowerOptions staff for the past 10 years. I handle a lot of the coaching sessions and education on the site. I have co-authored 2 books with Ernie as well, one on naked puts, one on protective option strategies. I am versed in all strategies on the site. There's 23 plus different strategies we support, plus some others. But I do like to be honest with everyone. There are certain strategies I've never traded in my personal account, things such as naked calls, short straddles, short strangles, and iron butterflies. These positions just don't match my personal risk-reward tolerance. So I've never traded them in my personal account, but if later on you have questions about those, we'll be more than happy to cover some of the tools as well. Well, let's go ahead now and navigate over to the PowerOptions suite of tools. What we're looking at right now is the main page of a trial account. As you can see, the PowerOptions suite of tools are arranged by a tab navigation system. And we start off with the main home tab, which is always locked in place, as is the My Portfolio tab. We'll get into the My Portfolio later on in the presentation. From the main Home tab, you can click on that link for the free coaching session. That will pull up the schedule so you can schedule a time that matches your convenience to talk with one of our experts. Next to that, we have the Learning Center tab. Let me navigate over to that very quickly. In the Learning Center tab, you can quickly access the PDF documents for the Quick Start Guide or the User Guide. You can also register for a coaching session. There's a variety of tip sheet white papers that are available, flash tutorials to help you get better acquainted with the tools on the site, and of course the webinars link. So let me go ahead and click on webinars, and this is where you'll see our archived webinars. Our upcoming webinars are over here on the left, and our previously recorded webinars are arranged by category on the right. So if we go ahead and click on the PowerOptions Tools archive, that's where we'll post today's presentation later on this afternoon. So you have some other discussions, broad overview, for example, introduction to PowerOptions focusing on covered calls and long calls, stock repair strategy tool, and a presentation on our historical suite of tools. We also offer discussions on the options strategies. So there's one on using PowerOptions to identify weekly options and what strategies a weekly options investor might use. Some other special stock dividends waiting to roll, covered call and naked put, the parity trades, vertical spreads, protective option strategies, and so forth. So there's a variety of different webinars that you can access at any time. As I mentioned, today's presentation will most likely be posted in the PowerOptions Tools archive later on this afternoon. Let us navigate back to the main home menu. For those of you that are just getting started out on your trial, I want to encourage you to take advantage of these 4 steps. The first step, of course, is the free user guide. When you first sign up for your trial, you'll see a form where you can request a printed user guide be sent to you, but we can also access that in the Learning Center, as we just saw. The flash tutorials, which are also available in the Learning Center. We host a variety of free live webinars during the week, so you can come join us for that, as of course you're doing right now. And then, of course, the free individual coaching session. Very briefly, down below, we have a variety of different pods set up here so that you can customize this based on what you want to see from market activity. My Power Watch list, these are just the stocks I'm tracking or the stocks I'm trading. I haven't adjusted craft yet to the new symbol, KRFT, excuse me, on our webinar account. We also have the market activity pod here so that you can see the basic view of the current indexes, our upcoming webinars. You see also have pods added for the ETF gainers and losers today and the top stock gainers. MMR, of course, we see that as a big jump, which is also a big jump in PXP. Just saw those two jump today, position that I'm in on PXP, and then MMR jumped up today. And if those of you haven't seen, that's because Freeport, I believe, is buying out both MMR and PXP, and they announced that today, so that's why they're both up a fair percentage of their value. In any case, we do offer other pods that you can select if you wanted to see the stocks that have the earnings announced today, stocks that have hit the new 52-week high or new 52-week low, top industry gainers or losers. You can just select those from the drop-down list. So let's go ahead and select top industry gainers, and that will place the pod in the next available slot. Let's also select the losers so we can see that. Okay, so we have industrial goods and healthcare down today. Basic materials are up. Once you select the pod, you can, of course, click and drag it and also continue to customize the view when you first log on. And, of course, if you want to remove a pod at any time, simply click the red X. That'll remove it from your available view, and it'll place it back in the available pod selections. And, of course, we can also minimize those pods as we showed before, just so we have the header. All right, now let's go back to the main links. Up at the top, the tab navigation system. As I mentioned, the portfolio is where we're going to track our open positions in the profit and loss portfolio. We can also view our closed positions in the historical reports or the analysis to see where a position stands. We're going to get to that at the end of the presentation. Next to those 2 pods that are locked in place, I have tabs listed for various strategies, credit spreads, and iron condors, married puts, collars, covered call, and so forth. We only see 7 strategies here in the available tabs, but I mentioned earlier that we do support over 23 different strategies. Well, if you trade different strategies and you don't see the tab available, we simply have to click on the Other Strategies tab, and that'll take us to the selection menu where we can pick and choose which strategies we want or rearrange the order of the strategies that we have selected. Now, before we go any further, we're going to launch a poll. We only have one poll for you today. And what I'd like to know to gear the rest of the presentation is what option strategies are you mainly trading or investing in right now? Are you mainly looking at covered calls and naked puts? Are you focusing more on protective strategies, the married puts and collar trades? Are you looking at vertical spreads and iron condors, again, the bear call credit and bull put credit that's shown? Are you looking at long calls and long puts? Or are you looking at the time spreads? It says diagonal and vertical. I thought I'd change that last time. It should say diagonal and horizontal. What we mean by time spreads are the calendar spreads, diagonal spreads, and the horizontals. All right, so just let us know which strategies you're viewing. I believe you can select more than one here. I have a lot of customers that have maybe 5 or 6 stocks, core stocks in their account, and they're trading those as covered calls, but they also trade the bulk of their portfolio with vertical spreads. On the other side of that, actually the bulk of my account is in the protective option strategies, married puts and collars, but I also do trade vertical spreads with about 10 to 15% of my trading capital with spreads on the indexes and ETFs, for example. All right, well, we've had the poll open for about a minute. I'm going to leave it open for another 5-10 seconds. If you haven't voted yet, I'm going to encourage you to do so. And this looks very similar to what we had selected the last time. So let me go ahead and close the poll, and I'll share the results with everyone. And what it looks like is that today in our audience, 60% of you in one form or another are doing the vertical spreads, the credits, debits, and maybe the iron condors. 50% of you are doing the protective option strategies, married puts and collars. 40% are doing covered calls and naked puts. 30% long calls, and 20% doing the time spreads. Well, let's clean this up a little bit. We basically, oh, let me hide that. There we go. We should be looking back at our selection field there. Fantastic. Well, we already have the bull put and the bear call selected. I'm going to go ahead and remove bear call. We'll move iron condor up for the time being. Second place in our poll was the protective option strategy, so let me move married put and collars. We do have covered calls and naked puts. And then, of course, we had long calls with 30% and time spread. So what I'm going to do, I'll leave off naked put for now. We'll leave long call. Then what I'll do is just select calendar call from our available menu. So we removed one strategy, removed bear calls for the time being. We're going to select calendar call. Just click Add to Menu. So you can choose to remove any of the strategies, select which ones you want from the available menu. Once you have the order and the selection that you want, we'll just click Save down at the bottom. We didn't see too much change here, but now we've added calendar call to our list of available strategies. We have long call, covered call, and so forth. All right, so what I did here is I just clicked on the calendar call menu. But let's go ahead and we'll go to bull put credit spread. Since the vertical spreads and the iron condors were the highest today, let's click on bull put credit spread. And when you click on a strategy tab, you'll of course be taken to the main strategy home. And on every strategy home, you'll see the same basic setup. Over here on the right, you'll see a basic profit and loss chart for the position. As many of you know, the bull put credit spread, we'd be selling an at or out of the money put and buying a further out of the money put. And this gives us the risk-reward profile where if the stock stays above both strike prices, both our puts will expire worthless and we'll keep the entire net credit. If you're just starting to research a strategy, you have the basic overview pod here with some bullet points for you to become more familiar with the site and the strategy itself. And then you can also click the link here for further in-depth strategy help. Down below that, we have the tools pod. And this gives us a basic description of each of the tools. The search tool is what we'd use to identify new positions in a given strategy based on our personal criteria. We have several sample searches for each strategy. These are theme searches for you to use as a stepping stone to help you create your own personal search. If you just want to look up positions one stock at a time, we'll use the search by symbol tool. And then, of course, you can also access the portfolio and the back testing tools, the historical suite of tools, through each strategy menu as well. Underneath of the Tools pod, you'll also see a basic Learning Center pod, and in the Learning Center pod, you may see a collection of white papers that discuss aspects of that particular strategy. For the vertical spreads, we have a link to 2 presentations that were done, 2 archive presentations, Vertical Spreads Part 1 and Part 2, which we saw in that webinar menu, for you to get more familiar with the strategies and more familiar with using the tools for that strategy as well. Okay, now let's talk about how PowerOptions can help you save time with your options research and analysis. Let's say that we talked a little bit, saw some stocks in the news. It's probably too late to do a spread right now on, PXP or MacMoran as FCX bottom out. But let's say that we have a stock that we've heard about in the news recently. And we're bullish on this stock based on the news report that came out, and we're going to look to invest potentially in a bull put credit spread. One stock that comes to mind might be Costco, for example. We know Costco is having a special dividend coming up in the next few days, and we know the positions and the options are going to adjust. But let's just take that as an example. So as I'm in bull put credit spreads, and I don't want to do the search right now because I know the stock. So I can start off by going into the search by symbol tool, and this is just going to prompt me to simply enter in our stock symbol, COST. Let's go into January for right now. And we have some basic filters here. Less results. The less results will just show you the deepest out of the money positions that have the highest probability, let's say greater than 75%, but are still offering a reasonable return. More results, this will still offer a reasonable return, but it will have a lower requirement for the probability, so we need to go as far out of the money on these positions. And then, of course, you can select all results to see all the combinations of bull put credit spreads. We'll COST, let's go ahead and start this off. We'll click Submit. All right, so what we have here is just a very basic view of the different combinations, 2.5-point spreads and 5-point spreads, that could be created on Costco. The first one we see, when we know Costco is at 104.74, we have a price up at the top. And the first spread is we could sell the January 100 put options, 45 days to expiration for 117, and this one is our 2.5-point spread. We could buy the 97.5 put for 79 cents. This results in a net credit of 38 cents, and the calculator returned based on the maximum risk. The maximum risk is here shown at 212. The maximum risk, of course, for this spread is defined as the difference in strike prices, 2.5 points, minus the net credit, which is 38 cents. So our max risk is 212. So the 38 cents off of a margin requirement of 212, there's our return of 17.9%. We have a probability of 73.9%. Well, if we wanted to look for a higher net credit, which actually results in a lower return, we see our second spread here, the 5-point spread. We're keeping more of that initial premium we sold for the January 100, so we'd get a credit of 65 cents, but it's a 5-point spread, so our risk is effectively doubled, and it results in a 14.9% return. We have the same probability. If one wanted to be more conservative, we of course could look further out of the money with the higher probabilities here, or range out of the money if you prefer to use that. But of course, as we know, as we go further out of the money, we're going to lower our return and our initial net credit. So it becomes here based on your personal risk-reward tolerance, what matches your minimum requirement for net credit or percentage return versus the probability or the range out of the money. Some of you may even use delta on the short option as a requirement for how far you like to go out of the money using the short option delta. Now, as I mentioned, this is just a basic view in the search by symbol tool for bull put credit spreads, but you can also customize this based on the data that you see. As you see up in the top here, we have this little blue button for see more/less columns. If we click on that, it's going to take us to a configuration page so we can pick and choose which columns we want to see in our search by symbol field, and she'll actually translate over into our main search field as well. So if I wanted to view the short option delta, or if I also wanted to view the percent out of the money, I could just select that. Now in the search by symbol tool field, you may not necessarily want to select a lot of the stock information because you're coming into this field as you've already done research and analysis on the stock and you're looking for a combination that best matches your risk-reward tolerance on these positions. But we could easily select other stock criteria if we want to see the average stock volume. The historical volatility might be one we want to see. So we can just pick and choose which data columns we wish to view in our results field. Once I've made my selections, I can reorder the columns, but we'll just click Save and Return for right now. And once we do that, we'll be prompted to close the window. Let's refresh our page. And now our new data fields will be added into our results view. So as I mentioned, we've selected to add our historical volatility. Well, it's the same value all the way down. We could have added implied volatility on either the short option or the long option. Here's our deltas for the short option, the option that we're selling, and then our range out of the money as well for the short option. That's our focus when we're doing a bull put credit spread. Now, this is a handy tool just to allow you to quickly compare the risk and reward one stock at a time, but we do have another tool that those of you who are actively trading spreads think you want to get more comfortable with, and I think it'll help you. Now, we could link to that field directly from this search. What the tool I'm talking about, of course, is the Midpoint Spread chain. We could link to it directly from the bull put menu. We could have put in our symbol up here, COST, and gone into the spread chain. And of course, now that we've run our results, I can decide to go directly from this view into the Midpoint Spread chain. Now these more information buttons, this is what's going to greatly help us save time again with our further research and analysis. We're going to go more through this information menu, the more information menu, when we get into the search tool. Let's go to the Midpoint Spread chain. I mentioned we can access it three ways. Now, here we see a field that came up, and it shows us that we can put in some basic requirements. This is a little bit more flexible than what we were just looking at in the Search by Symbol tool. So we can set our spread width for the position if we want to see just 5-point spreads or 10-point spreads, considering this, or I'm sorry, 2.5-point spreads. Well, considering the stock is up at 104.74, let's go ahead and keep it at 5-point spreads. We can put in our minimum net credit. Let's put in 0.25, 25 cents. Range out of the money, we'll keep this simple. We would just want to be 5% of the money, minimum return of 5%. Let's narrow this probability down to 70%. And then we can select our expiration months. If we wanted to go closer in, we wanted to look at December. Costco does not offer weekly options, so we only see the standard expirations here. But for stocks such as Apple or anything that offers the weekly options or the new consecutive weekly options that are offered on stocks such as Apple and Bank of America now, you'd see all of those expirations on the left-hand side as well. Let's go ahead and submit this. Okay, now I didn't see specifically what I wanted to, and that is I am in the put credit. So 92, 97 and a half. Let's fire range out of the money. Just give me 1 second here. I just wanted to check something. Let's see if I can narrow this down a little bit more. I'm trying to show something very quickly here, and I think we'll get it this time. Sorry about that. Nope. Okay. All right, so what we're looking at here is our 5-point spreads. I'm going to leave that field. Just pause for 1 second. I'm sorry. What I want to do is let me close this 95, 100. Let me close that very quickly. I'm going to leave those criteria. Let's link over from the 95, 100. Let's say that this was the spread we were looking at. I want to go to the midpoint spread chain. I had selected a 2.5-point spread, and that's not what I wanted. So let's go ahead and go here. There we go. This is what I wanted to see. Now, what this is showing us is it still pulled up that spread chain. It kept our base criteria. But what we're seeing now is this position that's highlighted in red. This is the bull put credit spread that we linked over from the main search tool. Now you see that we have a net credit of 68 cents. Our range out of the money is 4.5%, and there's our probability of 73.9. But what is important here, let's go back 1 second where we were. And it's not too different, but what we want to see here is when we looked at it on the search by symbol tool, we're showing a net credit of 65 cents, whereas on the midpoint spread chain, we're seeing a value of 68 cents. The standard search by symbol tool and the search tool uses the natural bid and the natural ask, but here on the midpoint spread chain, we're actually getting a little bit different value by using the midpoints. Oops, sorry, folks. So let's see some more information here. I can just click the plus sign, and this shows us the individual values for each leg. And as we see, by selling the 100 put, we had a natural bid of 117 and an ask of 120, so we may be able to get a couple extra cents from the midpoint and receive maybe $1.19. Whereas on our 95 put, the lower end put, bid of 49, ask of 52, so that gives us the value of 51 cents. So originally, we were just looking at the natural ask and the natural bid, but now using the midpoint, we can get a few cents out of that spread, a little extra bang for our buck. Now, what you're seeing to the left of this is the parity trade, excuse me. This is the bull call debit spread. And so what we're seeing here is we do have the bull put credit spread. We saw that already. But the parity trade, the similar risk reward profile, if we sold the 100 call and bought the 95 call, well, in this case, we'd have a debit of $4.37. So that means if the stock did expire above $100, we'd close out our position, get 5 points back, but we'd only receive a maximum return of about 63 cents. Not too much different. The return, though, we see here on the credit spread is 15.7%, and the calculated return on our debit spread is 14.4%. So in this case, it makes much more sense to stay with the bull put credit spread. However, let's see here, any of these, if we had gone further out of the money with the higher probability, and we were looking at that 95-90 spread that the bull put spread offered us a 28% net credit or a 5.9% return, we see that we may get a little bit extra value if we went ahead and went with the bull call debit spread, which offers a 6.2% return, so just a little bit more for the parity trade, and we can compare that side by side. For those of you who are interested in maybe an iron condor on one of these positions, a stock position or an index or ETF, well, instead of looking at the put credit and call debit parity, and you also have the bear call credit and bear put debit parity, if I click over to credit spreads, what this shows, we can put in our criteria again that I want 5-point spread width, want a minimum credit on each side of 25 cents, want to be at least 3 or 4% out of the money, and probability range. And now this gives you the combinations that you might be able to use, the bull put credit side on your right and the bear call on your left, to see which combinations might give you the best pricing to do an iron condor combination, that bear call credit and the bull put credit spread as well. Okay. All right, so let's go back to bull put credit very quickly. And we saw the search by symbol tool, but for those of you doing vertical spreads, I highly recommend that you get comfortable with the spread chain. Just using the base criteria is a little bit more flexible, and you get the midpoint pricing. For those of you that are doing the protective option strategies, married puts and collars, you're going to be able to use the search by symbol tool. That's where you want to start off with there. We don't have the midpoint pricing for the married put or for the collar, but we may have something like that, something of that nature very similar. Now, for covered call traders, covered call and naked put traders, there is a search by symbol tool, but for those of you doing covered calls and naked puts, I'm going to recommend that you use the option chain when you're looking to evaluate potential covered calls or naked puts one stock at a time. You already know the stock, you want to see the combinations. Let's click on option chain from the covered call menu, stick with COST for a moment. Okay, now, if I was interested in entering into a quick covered call or a long-term covered call on COST, well, we have our current stock price. And what we're showing here, of course, is just a static chain. You're probably familiar with this. You have our strike prices, the 100 call for December, which expires 17 days out. We could have a premium of 535, the ask of 550. Using kind of the midpoint there, we'd have a downside protection of 5.1% and a percent if assigned of 0.5%. What we're seeing here is that on the PowerOptions chain, in addition to showing you the basic information that you may see on a free chain, such as what are the current bid-ask, what is the volume, what is the open interest and delta, we're calculating for you the important returns that you need as a covered call investor. So you have your downside protection. You can select to view the annualized downside protection using that See More or Less columns button. Your percent return if unchanged, the percent if assigned, if the stock's trading above the strike price and you're assigned, percent if assigned annual, naked yield, time value, other important information, and of course the probability, which you won't see on any other chains. Now, for this particular example, with December so close and these numbers being relatively low, we may want to choose just to go to January on our chain, and so then we can see, still not too good for a covered call trade here. The in-the-money 100 strike call, low volatility on Costco, of course, we have a 5.6% downside protection, but a max return of only 1.1%. If I want to be a little bit more aggressive, I may use the at the money, which doesn't offer me a high downside protection, gives me a higher potential percent if assigned, 2.6%. That'd be a reasonable percent if assigned over a 45-day time period. Of course, we realize that as we go out of the money, at the money, slightly out of the money, we're going to lower our probability. So again, this tool here, the option chain, allows you to compare the risk and reward if you're doing a covered call, or if I was looking at the 5-strike put chain from the drop-down menu, we could compare the percentage naked yield and the percentage time value if we were looking to open a naked put position on Costco as well. So the numbers are similar. The naked yields, that's what we'd focus on here. So 1.2% for the 100, very close to the covered call yield, and 2.4%, of course, for the 105, the slightly in the money call. All right, now, for long call investors, one stock at a time, we don't have a search by symbol tool for to use, but we have something better. We have what's called the long option finder. Oh, and for calendar calls, you would use the search by symbol tool as well if you're looking up combinations one stock at a time to compare your risk reward. Long call, long put investors will click on the long option finder. Now, we use a different stock in this case. Let's say Apache is probably priced around $75, $74 per share, APA. Now, when you're interested in doing a long call or long put one stock at a time, it's because you've maybe already researched the stock or you're interested in the stock based on a news report, and you think in the next 30 to 60 to 90 days that stock's going to move up maybe 5 points, 10 points or so, and you want to see which calls are going to give you the best value. So right now, you may be going to your broker's option chain, looking up the calls, and either using a Black-Scholes calculator or binomial calculator on their site, or using a different calculator to estimate, well, if I bought the 80 call for January and the stock moves up 5 points in the next 30 days, would this give me the return that I want? Oh, well, the 80 doesn't look good. Let me try the 75. Does that one work? Well, let me go out to February. Let me see if that would better. Well, that's a lot of work. We're going to take care of some of that for you. So if I'm looking to invest in Apache, and the stock's, I think, around $74, $73 per share, and I think the stock might be trading about $80 per share in the next 30 days. So by January 5th, 2013, and let's say that I was looking to put maybe $1,500 into an options trade, a long call or long put trade. In this case, a long call because we're expecting the stock's going to move up. I'll put in my values. Let's click Submit. This is my expectation of the stock. And that brief instant, what the long option finder did for you is it went out and looked at every option on the chain for Apache, every call option, grabbed the current price, and then using the Black-Scholes pricing model calculated what that option would be worth if the stock did hit your target price on your trading date. So in this case, well, I was actually wrong. I'm sorry, folks. The stock's actually $77.74, so just a small move of about 2.5 or 2.25 in the next 30 days. What we're seeing here is that the January 72.5 call, which is currently priced at $620, based on our investment of $1,500, we could purchase 2 contracts. That'd be about $1,240. Throws in some commission costs for us, about $1 per contract, so it estimates a position cost of $12.42. According to the Black-Scholes pricing model, if the stock did hit our target price on our target date, our January 72.5 call would be worth $7.54. So we'd have a market value of $1,506, or a $300 gain, essentially on a $1,200 investment for a percentage return of 21%. So it organized it by which option would give you the best bang for the buck percentage-wise if the stock hit your target price. So all of that math, all of that manual math is being done for you. Now let's say we had an opposite sentiment. Let's say that we were, when we did our analysis, we feel Apache may drop 5 points in the next 30 days. Well, even though we access this tool, from the long call menu. Well, let's just put in our value of $72 per share. Again, on 1/5/2013, submit. These numbers are going to be higher, of course. But then again, the system just went through the entire chain of options and calculated if the stock was trading at this price on our target date, the 77.5 put, which is currently priced at $256, meaning we could buy 5 contracts. And if the stock hit our target price of 72 on our selected date, the long puts have a value of 560, or 118%. So this is going to help you save time analyzing those long calls and those long puts. You have an expectation of where the stock's going to be trading on a given date. All right, so that's one stock at a time. Spread traders can use the search by symbol tool, but again, I encourage you to look at the spread chain tool. Married put, collars, and calendar calls. You're going to want to use the search by symbol tool to look up combinations one stock at a time and compare your risk versus reward. Those who are doing covered calls and naked puts, I prefer to use the option chain rather than the search by symbol tool. I prefer to use the option chain so I can compare the different strikes and see my downside protection, or in the case of a naked put, what we call the percent to break even, how far the stock can drop before we start losing money on the position versus our return if unchanged, or our maximum return. And then the long call investors, you want to use long call and long puts, you want to use that long option finder. Now, I don't know a stock. I'm a spread trader, and I'm slightly bullish, so I'm looking at bull put credit spreads. I don't know the stock, but I know basically what I want to look for. I want to enter a spread that matches my minimum net credit. I want to have a good probability that the options would expire worthless. I want to look for stocks that are trading in an uptrend. Well, to start off, if I'm not sure which criteria I might use, I can go into the sample searches menu, and this is the same process I'd go through on any strategy, but we'll review the other strategies as well very quickly. So I may go into sample searches, and we just have a few theme searches here for you. There's a bull put credit spread search on ETFs. So if you wanted to just do credit spreads on ETFs, we have a default search that you can start off with and then adjust your criteria based on your specifics. There's one here on the 5-star bull put search. So it's only looking at stocks in the S&P 5-star list that are at least 5% out of the money. And then the safety first bull put search. These are stocks that are the large cap stocks over $10 billion with a high probability of expiring worthless. Let's start off with that 5-star bull put credit spread search, looking at stocks in the S&P 5-star list that are at least 5% out of the money. So when we first click on the sample search link, that's going to take us to a search field similar to what we saw with the search by symbol, but we have many different stocks now. So we have a couple positions on Apple that are listed. We can see the net credit. We focus there perhaps first, the percentage return, and the probability or range out of the money, depending on which you want. So this is just 5% out of the money. We're looking at selling the 525 put and buying the 515. This is actually 10-point spread. Minimum net credit of 285, max risk is 715. That equates to about that 40% return. We only have a theoretical probability of 66% and a short option delta of minus 0.32. Okay, well, this allows us to compare our risk and reward and see the percentage return, but we don't just want to go based on what was selected. Yes, we've created these theme searches to help you, but you still want to make some adjustments based on your preference. For example, this probability or this delta might not be in the range that you want to see for a bull put spread. You might want a higher probability. Well, what we want to do now is we're just going to scroll down to the bottom, and this shows us the parameter field where we can see exactly the criteria that were used to identify those positions that came up in the results. So we're looking for about 15 to 55 days out in time. So that would allow us to see any December spreads and any January spreads right now that matched our other criteria. As we saw, we're looking to be at least 5% out of the money, minimum basic return of 3%, net credit of at least 25 cents. We didn't put 25 cents, excuse me. We didn't put in a lot of liquidity here, just looking for an option volume greater than 0. That might be something you might want to increase. Of course, we know that looking at that Apple position, we know the open interest and the current volume today is going to be extraordinarily high as it is. And then, of course, I have a maximum risk entered of less than 9. Again, that's the difference in the strike prices minus your initial net credit. Now, if I scroll down below, you see that we have selected in the recommended list the S&P 5 stars, but we didn't select any industries or sectors. Now, there is, in any strategy, there's about 12 to 15, actually 15 to 20 different option criteria you can use. Those are mostly in the center section. Things for percentage return, net credit or minimum option bid, liquidity again, option volume, open interest. You can screen specifically for implied volatilities on the option or the ratio between Black-Scholes ratios, short option delta as we mentioned, and long option delta. And of course, over on the right, in any strategy, you'll have about the same 20 different stock criteria that you can use, both fundamental and technical criteria to narrow your results. Underlying stock price, important if we're doing Mary puts, collars, or covered call positions. Percent earnings per share growth. Oh, stock price might come into handy too when I'm doing these bull put credit spreads, or bear call credit spreads. If I'm doing a bull put credit spread, I may only see bull puts on stocks that are greater than $15 or $20, so I don't have that quick volatility or that high volatility we typically see with $5 stocks, $10 stocks, and so forth. Earnings per share growth, price to earnings ratios. If you're in that covered call field, or if you're in the collar field or Mary put field and you just want to search for dividend stocks, dividend paying stocks, we can do that as well. Beta, historical volatility, market cap, we only want to see mid to large cap stocks, average stock volume, and then of course the probability for the trade. And then we do have some technical criteria you can use, the relative strength index, the RSI, Bollinger Bands, the percent BB20, the percent bandwidth relate to the Bollinger Bands, and then of course you can also screen for simple moving average. Well, let's take this basic view and let's make some changes. Well, we're okay with our days to expiration, 5% out of the money, okay, we're fine with that. But let's say we wanted to keep our strike difference, the difference in the strike prices, our maximum risk, to less than or equal to 5 points. We don't want to see 10-point spreads. No problem. In the field below our range out of the money, I'll select strike difference less than or equal to 5. So I'm going to filter out any of the 7.5 or 10-point spreads. When I'm opening a new spread trade, or if I happen to be opening a new covered call or new naked put or premium generating strategy, one thing I always like to do is select the earnings date field to be not between now and expiration. Now that could work out to my benefit if I'm in a bull put spread, earnings are coming up, the earnings are very positive, and the stock gap's up in price. However, I don't want any surprises where I suddenly wake up, I had a profitable spread when I went to bed. I wake up in the morning, the stock's down 25%, now I'm essentially at the maximum loss. So I want to avoid some of those situations. So I check the box for earnings date not between now and expiration. If I wanted to increase my return, no problem. Let's say my minimum requirement is 5%. And I actually want to see a net credit of greater than 50 cents. It's perfectly fine. You can customize this search any way you want to. We can increase our volume. The option volume here relates to the total number of contracts traded today. Let's say I want that to be at least 50, and I want my open interest to be at least 100. Again, if you have a preference that you want it to be greater than 1,000 or maybe the greater than 10,000, you can just put in those values. What about the stock itself? Well, we talked about looking for stocks maybe greater than $15, so we don't see any of those low-price stocks with our credit spread that have a higher volatility. We already narrowed this down to the S&P 5-star list. We know that's only stocks are the Standard & Poor's 5-star. But if I wanted to open my universe more, we could change this to no lists. And then if I change it to the no list, what I'm going to want to do is narrow it further down using things such as the earnings per share growth, look for stocks that have grown in earnings, from last year to this year. I may also want to look at shares outstanding or market cap, for example. Keep a relatively lower volatility or reasonable beta. We could put that in as well. The probability. So then we only want to see positions that have at least a 75% probability of expiring worthless. And lastly, let's just go ahead and change. We want to see stocks in an uptrend. So basic view I might use if I'm looking for a 20 or 30-day out position. I'll currently look for stock price to be greater than the 50-day moving average, our SMA 50. All right, so adjust those changes. We adjusted only the strike price, put in some liquidity, increased our minimum net credit and return, increased our stock price range. We want to see higher price stocks in our probability. We only want to see positions that do not have an earnings between now and expiration. All right, so let's go ahead and submit. Now I want to tell you that at every 20 minutes, of course, in the background, all right, so we don't have any stock or options that match our criteria. No, I think I know why. I'm sorry. Hold on one second. For right now, let's go back to none versus none. Had a pullback recently. I wonder if, I think I see what I did. One moment. There we go. So we still have Apple, but we're looking at the 5-point spreads for Apple instead of 10-point spreads. Baidu, PXD, Pioneer Natural Resources. So we have our different combinations. CVX is in there as well. Different combinations for our positions. And as we mentioned, one of the things that gets confusing now with Apple is that we have a variety of expirations. So we have the December 17 days to expiration. That's the standard December expiration. 23 days, what is that? And then 45 days is our January. Well, the 23 days, as I mentioned, Apple is one of the securities that now offers consecutive weekly series, meaning that for every 5 weeks, when you're looking at a position, Apple options will be available every 7 days for 5 weeks consistently. So you'll be able to trade the weekly, the twice weekly, the 3 times weekly, the standard expiration, and the 4 times weekly. They'll all be available for you to trade. So standard expiration is 17 days out. The next cycle, which would be kind of the tri-weekly, is 23 days out. And then we have our standard January expiration. Right, so that's why we have various combinations for Apple and Baidu and even PXD. Okay, so where I was going before the results came up, we had to make that brief adjustment. I'm sorry. Yeah, so we changed the simple moving average, that's all. Every 20 minutes, the database, we're compiling close to 1.6 million credit spreads, bull puts, and bear calls. Now, with just tweaking some of those basic criteria, we didn't put in a lot of things, did we? We just put in a minimum stock price, minimum return, minimum net credit, some basic liquidity, a time frame. We only want to see 5-point strikes or less, avoid earnings, probability of 75%. That's the only criteria we put in. We left, of course, that we're only screening against stocks in the S&P 5-star list. But with just those base criteria, we've narrowed that entire universe of possible spreads down to 15 results. So what is the next step? Well, we want to further research and analyze the positions in any strategy. Once I've put in my criteria and I've run my search, my first step is I'm going to use the More Information button, and then I'm going to look at the stock chart. And you can look at the one-year snapshot or big charts. Well, let's click on big charts. We're not going to talk about reading charts today, but we're just going to pull up some of the process. Now you can customize big charts here using different indicators. I've selected Bollinger Bands, of course, also have the MACD selected as well. Now we're doing a bull put credit spread. And what I'm looking at first is if I go ahead and find my positions, we clicked on the More Information, we went to stock chart. If for whatever reason I don't like this trend, now we do know, of course, the spread we were looking at the 525 strike, I believe, and the 520, or it was 520, 517, so we're in this range. But if I'm not comfortable with this chart for a bull put credit spread, okay, I'm just going to close this down. There we go. So essentially what I've done here is I've said I don't like that chart for a bull put credit spread, not just the 520, 515, but basically every spread here that matched my criteria for this stock I'm no longer concerned with. Okay, we're just manually, I'm just saying that, okay, I'm done with Apple, I don't like those combinations. So without even doing any further research and analysis, without even delving deeper into any of these spreads, I'm going to go right to the next one. We'll go to the December buy-do position. The stock's at $90, so we're selling the 85 put, buying the 80, net credit of 72 cents. So let's go ahead and we do the same process. First step, I'm going to take a look at the chart. And I might say, wow, this to me has been breaking down, so this looks even worse. So now I'm done with that one. And then, it keeps going to that one. I apologize for that. Well, we've crossed off Apple and Baidu, so really all we have left is PXD and Pioneer Natural Resources. Let's take a look there. Okay. All right, so this looks pretty good. The spread position we were looking at for PXD, the stock at 103, we're selling the 95 and buying the 90. There we go. Let's maximize that. And so we see here some support and resistance right around 100, so this might be a viable spread. I want to make sure that they're, the last earnings date and I don't have earnings coming up between now and expiration would verify that. But this might be a better neutral to bullish chart that I might be considering as opposed to what we saw with Apple and Baidu. Okay, so let's go back. Oh, 1 second. Dennis asks, can you eliminate weekly options in your search? Yes and no. Let's go to that very quickly. We do have the weekly series here, as I mentioned. The tri-weekly here is in 23 days. It gets a little bit confusing now, Dennis, for us because these new securities that offer this consecutive weekly expirations just came out a few weeks ago, 2 to 3 weeks ago. But let's say I know that the standard expiration is standard December expiration is 17 days away. The best way to do that now is just use your time frame. So I've selected all months. If I want to remove the, I only want to see the December series, well, I would just, put this greater than 16 to, let's say, 18 days. That would show me only December expirations once I know the dates to expiration. Or I could, now, I would want to choose just December. But for now, if I just wanted to see the January series, as we saw for PXD, which matched our results as a January expiration, if I didn't want to see the weeklies, just want to see those, I could select January. We'll submit that. Now we'll just see PXD, Baidu, and a couple of our Apple positions that we've already relegated. Oh, and the Chevron Texaco one would be in there as well. Okay, so that's how I'd recommend, Dennis, eliminating the weekly options, is just use your days to expiration to force it to focus just on the standard expiration for now, for December. But if you go out to January, I don't think the new January weekly options are available yet. I think they're going to come out Thursday morning. But we could say January and say I want to be at least 30 days to 45 days to expiration, and that would put you at the standard. We are going to enhance that. The problem is what we had before, Dennis, is that we do have a selection here for weekly options where you could choose just to screen against those, but those were the ones that were flagged through our, that we flagged specifically through our data provider that expired within the next 9 days. Well, now it's tricky because technically this consecutive series, they're not really weekly options. I mean, they are, but you'll see weeklies that expire 21 days, 23 days, 18 days, as we saw before. So technically, they're not really weeklies. They're 21 days out and 23 days out and so forth. But yes, we are going to have something here available for you where you could select to view just December expiration without the different weeklies, or you could select to look at just a consecutive series if you wanted to. All right, let's go back to our search here. We decided that we took out Apple, we took out Baidu, we didn't like the chart. We liked the chart for PXD with our spread position. So we looked at the profit and loss, we looked at the big charts. The next thing I want to do is look at the company news and information. So I'm going to take a look at the recent headlines. I want to see if there's anything that might cause me hesitation for entering this position. Is there anything about dismissing members of the board, boardroom scandal, anything about a buyout, or is there anything that just may cause me hesitation to enter this position? A patent lawsuit. In this case with Pioneer Natural Resources, they're probably mining and drilling. Are they sitting on a large number of contracts that hasn't been approved yet for land lease or land ownership or mining rights, where if it comes out by the time in this trade, it could cause the stock to drop if they decline the use of that land or the lease of that land, for example. Those are things I want to know before getting into the position. If I'm not familiar with this company, I also want to take a look at the profile, see the sector and industry. I may actually, at that point, I may actually compare it to leaders and laggers in the sector and industry as well. I could look at the earnings and events. Now the research, you could go into further depth with the detailed stock research or option research for the short leg or the long leg. This just takes you to our detailed research page for the stock or for the option, and essentially this just shows us all of the available data that we have for that particular security. In this case, so that we see we have all of our fundamental and technical data for the stock, broker recommendations, and so forth. Okay, so let's go ahead and close that window. Back to our search. So we identified it, stock chart, company information. We could delve into further research. I'm comfortable with this spread because it matches my net credit, minimum requirement, our probability, and range out of the money. But as we did before, now that I like the stock, if I want to be more conservative or more aggressive, we can compare it to the other spreads. We'll go to Midpoint Spread chain right from the search. And there we go. And there's our bull put credit spread. And we saw for PXD, which matched our requirement. We can see here now, even using the midpoint spread chain, that the deeper out of the money spread, using the 90.85 and the 85.90, didn't match our minimum net credit. Remember, we had that minimum net credit of 50 cents. Both matched our return and our probability, but we didn't get the net credit we wanted, so that's why they weren't shown. And of course, if I lowered this, we could try to force in the 195 spread. That probably wouldn't have the probability we want, but would definitely have the net credit and the percentage return we're looking for. So it looks like we're still sticking with this spread. But again, as I mentioned, when analyzing a spread, once I've run the search, I'm coming to the midpoint spread chain. See here my minimum net credit, or the best net credit using the midpoint is 85 cents. My percent out of the money is 8.6%, and my return is 20.5%. But what I have to consider is the debit spread. 85 cents is the max return here, so we have a risk of course, 415 on our bull put credit spread. The midpoint pricing for the call debit spread is 370. That means the maximum return, if the stock ended above 95 as we're expecting, we'd close both legs of our bull call and we get $1.30 back. We'd get the 5 points back. We paid 370. We get $1.30 back. So this would actually be a 35.1% return on the bull call debit spread as opposed to a 20.5% return. So even though I was interested in doing bull puts, I identified the positions that matched my criteria. We found the stock that we wanted that went through the stock chart and so forth. But maybe now I'm considering doing the parity trade because there's more bang for the buck. We're looking at a potential 35% return with the same probability, the stock trading above 95 in the next 45 days. So we can close out both legs of the spread and we'll get a $1.30 profit against a 370 investment instead of an 85-cent maximum profit off a 415 investment. This is where that spread chain comes in handy. So I can see here that this is definitely giving me, the bull call debit spread is giving me more bang for the buck as well. So let's go back now. We could decide if we wanted to enter the bull put credit spread trade now after we've done our research and analysis. We could go to the broker link. Now right now the broker link, we only link to Options Express or Brokers Express. So you could leg in the position as a bull put credit. I'm sorry, you could enter the bull put credit spread once, or we could leg it in the position by selling the put and then buying the put. If you're not using Options Express and Brokers Express, we could go ahead and just you log on your broker, place the trade. and then we come back to add to portfolio. Let me go back to the midpoint spread chain real quick. Now if I logged onto my broker to place the trade, what I'd want to do is make sure that I'm using this as my limit order, my limit net credit of 85 cents using the midpoint pricing. The natural bid ask was only 70 cents, so this still did match my criteria, but as I mentioned, we're getting more bang for the buck with that midpoint pricing for the same spread, the 95.90 on PXD. So we're getting more bang for the buck there, but this debit spread on PXD could really help us out because it's getting more value. Now let's say here at this point we decided to go with the debit spread because we want to get the potential of $130 profit as opposed to 85 cents if the stock does what we're expecting and stays above $95. So right here from our menu, I don't have to go back into the bold call debit spread and the search by symbol. We can choose to trade with broker link right here from our further analysis from the midpoint spread chain tool and add to portfolio, and that's what we're going to do. Let's go ahead and click on add to portfolio so we can start paper trading and tracking this position. Now, if this is the first time you're accessing the portfolio, you'd only see this choice available, new portfolio number 1. You would select that, and of course you could change the name for the portfolio. We could call it debit spread trade or credit spread trade, for example. And what this would do is initially create a paper trading portfolio in a sense. It would start you off with a cash on hand basis of $100,000 and buying power of $100,000, but you could change that later on. Well, we're going to, since we already have existing portfolios on our webinar account, we're going to go ahead and add this debit spread into the paper trading spread positions. Now we want to remember that let's go ahead and click Insert. This is going to fill in the basic information for us. I'm coming up from that spread, and it's showing us we're going to buy the January 90 call at $14.25 and sell the January 95 call at $10.55. So there's our debit of $370 for this position. But if we if we get the maximum profit as we're expecting, if the stock stays above 95, which is why we've gone through those steps for the research and analysis, we'll get the full profit. We'll get $5 back and make it $1.30 as opposed to 85 cents. So let's go ahead and submit that. Of course, I'm leaving the commission fees at 0 because this is just a paper trade. This is not a recommendation or suggestion. Okay, so that's kind of funny. I forgot we did this. It looks like last week, or 2 weeks ago, I'm sorry, 2 weeks ago, when we ran our search, during the webinar, we ran a search for bull put credit spreads. Look what else came up. We found the PXD bull put credit spread, and we sold the December 100 put, 95 put. And what we have here, as we can see, let me go back a second. Here we're seeing the different spreads that we have. We entered a bull put credit spread earlier. We have a bear call credit spread that was entered last week during our webinar, and we have the PXD position that we just entered today. Now what we're seeing in the portfolio is the listing for each individual leg. So taking our new position, here's our 95 call in PXD, and here's the 90 call. There are prices. We sold to open the 95 at $10.55, and we bought to open the 90 at $14.25. Now, of course, we have our bid-ask spread differences. So this is showing us the natural ask price at $10.80 for the option. We sold natural bid price for $13.10, so you can see the gain or losses in the individual legs. Now, it's great to see the legs individually, but what I've selected up here at the top, I've gone ahead and selected the box for View Position Analysis. And what that does, so I scroll over to the right, this allows me to see the gain-loss for each individual position. All right, so our first position on PXD, we received a net credit of $850. That was the bull put credit spread. And right now we see a liquidation value of $10.50. So if we bought to close our short option for $1.35 and sold to close our put option for 30 cents, this would have a cost basis of $10.50. We use 10 contracts. So we'd have a loss of $200 or 23.5%. But what this is comparing, we see our liquidation value right now, these all look pretty bad, but what we're focused on is the expiration gain or loss. Now what this means is we're not projecting where the stock's going to be trading. We're saying if the stock, in this case, PXD, stays at the same price, 103.93 right now, to expiration, Well, both puts are going to expire worthless, and we'll keep the net credit. Same with our bear call spread. The bear call spread on CMG, Chipotle Mexican Grill. We currently have a loss of about $10 right now, or 11.1%. And if we hold the position to December expiration, the stock stays where it is, we'll receive the 90-cent maximum credit, or 100% of our expected value, as we see with the bull call debit spread here as well. So that gives us a better view, the position as a whole, the combined lengths together, so we can see exactly where we stand, what our expectations were, where we stand today, and where we might be at expiration if the stock stays at the same price. Okay, so as we're looking at the bull put credit spread on PXD, the one we entered back in 11/21, we see that the alert column here has been triggered. Highlighted in red here, we see that the alert's been triggered. For every position you enter, you can set different alerts. Now, we did set alert for the lower stop limit here of 101, telling the system we wanted to be notified if, I'm sorry folks, PXD dropped below 101. As we did on the bear call spread, we set an upper stop limit, so we wanted to be notified if the stock goes above 275. We've sold the 285 call, I'm sorry, we sold the 280 call and bought the 285, so we put in a stop here of 275. If the stock moves up to that price, we're going to look to manage this spread or roll out of it, depending. Okay, but we have an alert triggered on our bull put. I want to see what it is. It's not the lower stop limit. We're still above that because the stock's at 103.93. Let's go ahead and click on View. This will take us to our alerts page. Okay, so here's what we see. We put in an alert to be notified if the stock drops below its 50-day moving average. The stock price actually is currently at 104.42. It adjusted in real time when we linked over. And the stock's trading at the simple moving average, the 50-day moving average is 104.72, so we're below that price. But some of the other alerts that we've set on this position, we could put in values for the percentage stock change. We just happen to use a hard number for the lower stock limit. The percentage option chain, time value. Days to expiration, that always helps. I want to be notified if I'm within 5 days to expiration, especially if you have a portfolio that's comprised of weekly options, standard expiration, maybe 2 or 3 month out options. That's a helpful notifier so you know which ones are coming up to expiration you may want to manage or adjust. Okay, and let's see. Oh, sorry, Frank, I just saw your question. I'll get to that in one moment. So we could set alerts for leg 1 and leg 2. Sorry. Then we can also set an alert for the position change as a whole. If we've dropped 20% or 30% on liquidation value of the percentage, whether it's a spread or a covered call or Mary put or a collar, we can put that in as well. And you can also put in alerts for your technical criteria. Now, normally, in the example 2 weeks ago, when we found the PXD position again, we were looking for stocks that were trading above their 50-day moving average. If that's one of the filters that I used, well, I want to be notified if the trend is reversed, and that's why we set that alert. We want to be notified if the stock drops below the SMA 50. I could also set a secondary alert if the stock drops below the 20-day moving average or the 100-day, or if the 50-day drops below the 100-day. If you use Bollinger Bands in your filters, you can enter that in as well. And then, of course, the days until earnings. So if I happen to be, I use this more for collar positions and married puts that are longer term. You know, if I'm 2 or 3 months out in time, or I opened a married put where I bought a put that's 6 or 7 months out in time against a stock I'm expecting long-term growth, I know I'm going to cross an earnings date, and I'm okay with that because it's an insured position. I'm not worried about a decline. But I still want to be notified if I'm within 5 days to expiration, or if I'm trading a covered call. When I say expiration, I meant earnings. I'm sorry, folks. 5 days to earnings. And I may do that with a covered call position as well, because I may want to add a put option if I'm coming up to expiration in case the stock declines 30%, so I make sure I don't lose more than 5 or 6%. Or I may want to buy to close the short call I have open just in case the stock gaps up. I don't want to be capped out by that short call position. So you can put those alerts in as well. And then, of course, as we saw, when an alert is triggered, we can then decide if we want to make an adjustment to the position or leave it open. And I think with this one, we're going to just leave the position open. We're not going to make an adjustment on the position. However, if I did want to make an adjustment, as I'm tracking positions in the portfolio, or I'm concerned that I need to manage this position, if you're tracking any position in the portfolio, what we can do is click the More Information button, the little blue buttons next to the position. We'll go to Position Actions and then Position Analysis. The profit and loss portfolio, once we enter the position, I didn't point that out, but once we enter a position, we're going to link to the profit and loss portfolio. That's where we track our open positions. From the profit and loss portfolio, we saw those open positions. If I link to the position analysis view, we can see right away that, I'm sorry, let's scroll back up. This gives us a breakdown of our position a little bit more in depth than what we saw by checking the box for view position analysis, which added 6 columns. But here we see our static break even, the current price, original net credit, original maximum risk. There's our static profit and loss chart over here on the right. As we scroll down below, we see the calculations for the original net credit, the current liquidation value. We saw that on the other field, but we can look at more details if we want to here. And the future expiration value if the stock stayed at 103.93 in the next 17 days. Now down below that, you may see some rollout opportunities based on where your position stands, where the stock is in relation to your position. Now since the stock hasn't reached within 1 or 1.5% of our short put strike price, and since it's still within a trading range, what we're showing here are some condor opportunities. What it calculated for us are potential bear call credit spreads that we could add on top of our bull put to create an iron condor. So we have some combinations here, for example, of the 110 call and the 115 call, the net credit of 40 cents, current probability of 79, so this would potentially increase our return or our monetary profit. Now it's great to see things like this numerically, but as I'm evaluating a rollout opportunity or an adjustment, we can use the more information button next to the potential adjustment and click on simulate trade. And this will give you a side-by-side comparison of your original position. The original position is shown in the left in red. So there's our bull put, current loss of 3.6%, max return is 20.5% if the stock stays above 100 and both puts expire worthless, max credits or the max profit of $850. Now if we add this condor, we change the dynamic of the spread in the sense that we're still expecting the stock to stay above 100, so the bull put credit spread expires worthless, but by selling the 110 call and buying the 115, we'd also be saying that we expect the stock to stay below 110 in the next 17 days, so above 100 and below 110, so right at 105, in the next 17 days, all 4 legs would expire worthless, and our maximum return would go up to $1,300. Now it's about an additional $450 to increase the monetary return on the position. Now, because it's such a tight range, I'm probably not interested in doing this at PXD. My short put's not being threatened yet. It hasn't hit my lower trigger limit of $101 that we entered into the alerts, but we are notified now the stock has changed its trend. It is trading below its 50-day moving average, so that's going to be something we're going to want to pay attention to and maybe watch a little bit more carefully. Okay. Now, Frank's question goes back to stock and stock ownership and dividends. Frank says, I assume that if dividends are entering the portfolio, the cost basis reflects this. That is correct. Now let me discuss what Frank means. Let's go into another one of our portfolios here. I'm going to go into the married puts portfolio. No, I'm sorry, I didn't want to do that. I want to go into the, I don't think I have one here that's a dividend one or that we've been tracking a dividend. So let me go into covered calls. We'll go paper trading dividend covered calls. So side by side over the past 12 months, we've been comparing covered call portfolios that we open up in during the webinar for covered call screens versus other strategies. And the last 12 months managing certain positions, the covered call portfolio is only up about 2.1%, where we saw 11% gains in some of the other positions. Okay. All right. So what Frank wanted to know is, does you see here, let's take a couple of these positions. We have Prudential that we opened up at $49.80. We traded it as a covered call, and you notice our effective cost per share has dropped down to $42.91. We've rolled a few calls, so we've been able to lower the cost basis on that position. Now, from the portfolio menu here, let's go into analysis. I just want to see, is there one? I thought there was one here. There it is. Oh, yeah, there it is. It's Prudential. Now, we did have a call, Frank, that expired worthless here on Prudential. It was only one contract. Yeah, it was one contract, and we took in about $6.45. We sold the in-the-money 45 call, and we actually closed the position, and we made the full profit on that particular leg. But you also see here that we've adjusted. We collected the 22 shares. We should have added another one in. I apologize, but we've taken 22 per share for the dividend, and that did adjust the effective cost per share. Now, why is that important? Oh, sorry. Let's go back to the profit and loss portfolio where we track our open positions. Now, we did enter Prudential originally with a cost basis of $49.80. We've collected a few dividends, sold a call against it, lowered our cost basis to $42.91. That's our effective cost per share of the stock. We don't have a call open on it right now because the stock kept moving up. We didn't want to cap our gains. And that's actually helping the portfolio, not hurting it, by not selling a call recently. But now, if I go into the position analysis menu, what we're going to see here is that it is going to calculate potential rollout opportunities for us based on our long stock position. We could consider selling a call for income. We could lock in profit by purchasing a put option far out in time. It shows we've risen 22.5%, so we could lock in some of that profit. If we bought a March 60 put, for example, we'd be guaranteed a profit of 16.9% in the worst case scenario if the stock falls. But if the stock moves up, we can still continue to do other adjustments and realize further profits. A bulletproof position, no risk, guaranteed profit of 16.9% with still an unlimited upside. We consider just selling a call, and that would give us the calculation for the new percent return if assigned if we sold the January 55 call. Or we could create a collar, have the best of both worlds, buy a put option for protection and still generate some premium up front by selling a call against the position. But it's basing it off of our effective cost per share. This includes everything, positions that we've closed, rolled, or dividends we've collected. So yes, Frank, it does do that, and that's important because when you go to the position analysis, it's basing it on your true cost basis, not our original price of $49.81. All right, so let's get back to the portfolio. Did have another question here. Dennis asks, after taking an initial position and the stock gaps up or down, does PowerOption recommend strategies to modify the position? Yes, Dennis, if they're available. What I mean by that, do I have it in our portfolio? Let's take a look. Let me go back to married puts. I talked about PXP earlier today after being bought out by Freeport, and I had removed it. Okay, we had closed out of that position where we were tracking a PXP married put. I had traded 2 married puts over the last 9 months on PXP. But if we saw that gap up today of 451, we'd be able to view potential rollout opportunities. But in any of these positions, AICI, for example, we've been in this for about 90 days. I think we've done an adjustment or two on it. We've been in the position for 98 days in our age column, and the stock's down 16%. It didn't gap down 16%, but it's down 16% from where we opened it. So in the case of moving down in price, tracking the married put position, we can go to position actions and position analysis. Again, this will give us a breakdown of our position. We know the stock, I'm sorry, what was that again? The stock was down 11.5%. Okay, so the maximum risk on the married put was 6.7%. Even though the stock's down 11%, we could liquidate right now for only a loss of 6.2%. If we hold it all the way to expiration 136 days away, and the stock is still trading at the same price, $43.86, we'd have the maximum loss of 6.7%. So yeah, because of the 11% drop, we're not receiving the full loss yet. We're pretty much hedged out on the position. But even though the stock is down, we see some adjustments, some rollout opportunities here for that position. Now, in the case of a large decline, that's a little bit tougher. Okay, so if I had just bought a stock and 2 weeks later an early earnings warning announcement comes out or some news comes out, or maybe we just cross earnings, Dennis, and my stock drops 25%, it's going to be difficult for me to see some realistic rollout opportunities or adjustments. After that, a kind of event like that, it's hard to get back to break even. You probably won't be able to get back to break even. Now, that being said, if you have a stock that's down in price, one of the tools that you can use is the stock repair tool. Let's keep Apache as an example. I'm going to show this real quick. We are at 1:15, so we want to wrap up quickly. If anyone has any questions, any last-minute questions, I promise a Q&A session, go ahead and send those in to us, and I'll answer those as well. But let's use Apache again as our example. We'll go to stock repair. Now, remember earlier we saw that Apache was trading currently at 77.24, 77.74. I apologize. But what I want to put in is my cost per share of $85. And we'll just put in that we own 100 shares of stock, and let's click Submit. Okay. Now, what this tool tried to do is build a ratio spread, selling 2 calls and buying 1 to help us get back to break even. What the first line is showing us is that it tried to build this stock repair ratio spread by buying 177.5 call and selling 280 calls, it did receive a net credit for that spread, but it didn't help us get back to break even. In fact, it'd be locked in for a loss, so we're not showing further details. However, there is one that's far out to April, which was able to use buying 177.5, selling 280s for a net credit of $2.80. Now, what's interesting, we bought the stock at 85. Oh, it moved up. The stock's currently trading at 78.11. But in this case, with this repair, we see that we've taken the break even to 79.85. So we only need the stock to be trading at 79.85 by April expiration to get back to break even. We don't need it to be back up at $85 per share. Well, how does that work? Let's take a quick look at the repair details for that spread. And what this would entail is we would buy an April 77.5 call for 540, sell 2 April 80 calls for 410. Now, if you're in a restricted account where you can't trade spreads, you wouldn't be able to perform this adjustment. Because essentially what your broker would see is this may look like a covered call. You have 100 shares of stock, so selling one call against that would be a covered call, but then you have a bull call debit spread. Now, if I have 200 shares, I could do this. If I had 200 shares of stock, I could sell 2 Apple 80 calls and buy 177.5. This would still look like a repair to me, but my broker would just see it as a covered call with 200 shares and 2 short calls against it, and then I went ahead and bought an extra call as well. Okay, in any case, by entering this position, we're going to sell 2 at 410, so we'll take an 820 and pay 540, so we'll receive $280 or $2.80. Now, what would happen if the stock's trading at 79.85 at April expiration? Well, our 2 calls would expire worthless. The 280 calls would expire worthless. We have no obligation to deliver stock. We'd have a loss of $515, 79.85 to $85. That's a total monetary loss of $515. We keep the net credit of $280, but remember, we're paid to own that 77.5 call, which would now have a intrinsic value of $235. Again, this is only at April expiration. So the $235 plus the $280 net credit, that counters the $515 loss we have in the stock. Our total market value is now $85, which is what we purchased for the stock, even though the stock's only at $79.85. What's the catch? Well, the catch is that if we take a look at it, that looks great. I mean, that is fantastic that we'd only need the stock to move up another $1 from where it is right now at April expiration, 4 months away, to get back to break even. We don't need it to go all the way back up to 85. But what's the catch? Well, you own 100 shares. You sold 2 calls and bought 1. So now you have a capped gain. Let's click on Analyze Trade. Sorry, folks. There we go. That's the trade-off. Okay, so we did lower ourselves so we came back to break even, but in the next 30 to 60 days, remember this is at April expiration. That's not a good view. Sorry, folks. Let's scroll down. There we go. It's a little bit better view for you. So by entering this spread now, if the stock moves back up to 85 or $87.50, we're hedged out by this short 2 calls. So the max profit we might expect, or we could expect at April expiration without adjusting it, is only $30 or 0.4%. So in this case, if I run a repair, and the only reason why I would run a repair, by the way, is if I have confidence that the stock's going to come back in price. Because what does the stock repair strategy not solve? What if Apache continues down? I still have maximum risk on the position there. That's not what we want to see. I mean, we still have continued loss that we could realize. So I'm expecting the stock to move back up. But in this case, if my expectation is the stock might be trading at $82 or $83 in the next 30 or 60 days, I might be better off just using an out-of-the-money call for January and then for February and then for March and then for April, so I'm not stuck in this position where I'm hedged out. And yes, I get back to break even faster, but I'm only realizing a value there of 0.4% or $30, and that's 4 months away. So you have to take that with a trade-off. Now, will this work? Will a stock repair work in the case of a stock dropping 20, 30, or 40%? Probably not. I mean, you can run it. You might see 1 or 2 opportunities, and they might be 6 months to 8 months out of time. So you have to decide if it's worth it in that scenario for you to do that. Of course, if I have a 20% drop and I can open one of these repairs so that in the next, let's say, 6 months, I only need a stock to move up 2 more points as opposed to moving up another 8 points, that might be a fair trade. I might be willing to take that, have that capital sitting on my account for that 6 to 8 months just to get back to break even or get closer to break even in that scenario and not take the 20% loss. But the resolution, We say this at the beginning of the webinar. The resolution, of course, is to it's easy to say, but if you're trading stock positions such as covered calls, or maybe you're trading naked puts, you're going to want to check out some of the information on the married puts and collars. The key there, is how do I avoid positions like this, is not allow yourself to get in that position in the first place. When you're entering stock positions, always do it with an insurance policy in place. You're never risking more than 5, 6, or 7% on any one position. All right, well, let's navigate back over to our slide presentation. Let's wrap this up. Again, I want to invite you, if you have any last-minute questions, go ahead and send them to me. I think we've covered this. Why power options? Why do we feel you need power options? A patented search and over 23 different strategies specifically put in your criteria for the stock or for the option. Even if you're just looking one stock at a time, there's a variety of tools that will help you quickly identify which spreads, which long calls, or maybe which covered calls and naked puts best suit your risk-reward profile. And you can customize the searches and the screen views. We added the data columns there for the search by symbol and for the option chain. And then of course the paper trading tools are very helpful in tracking and managing your positions as well. And of course we do offer toll-free customer and email support and all the different webinar archives and help strategy tips we have for you. For those of you that are on a trial and you're curious about the pricing, our 20-minute delayed service gives you access to all the tools and all 23 different strategies at $60 per month. We do offer a real-time service, which is $80 per month. So every time I run a search or refresh the page, I'm getting the numbers at that very instant. And then our third level of service is the real-time service with unlimited access to the historical suite of tools for backtesting your strategy based on your criteria or looking up positions one symbol at a time. And that's $100 per month. And then discounts are available for the yearly subscription. Our upcoming webinars for Power Options every Friday at 4:30 p.m. I haven't posted this yet. We'll do that soon. But every Friday at 4:30 we host an open discussion, open forum presentation. During that webinar I don't have any planned material. We just handle the questions that come in from our attendees and use the PowerOptions tools to show examples. Of course, every Wednesday at 12 noon we'd like to host the Introduction to Power Options presentation or a strategy presentation. And every Tuesday and Thursday at 12 noon, Kurt Frankenberg hosts the Introduction to Radioactive Trading presentations. That limited risk trading we were kind of talking about a little while ago to help avoid those losses for unexpected black swan events. All right, well, ladies and gentlemen, thank you for joining me today. If you think of any questions later on, please feel free to email us at any time to support@powerop.com. If you live inside the continental U.S., you can also reach us toll-free during market hours at 877-992-7971. If you live outside the continental U.S., you can reach us at 302-992-7971. Of course, there's contact links at the bottom of every page. Thank you again, ladies and gentlemen, for joining us. I hope to see you again real soon for one of our other webinars. Take care and happy trading. Good night.